Welcome back with Niaga AWANI. We're still focusing on the global inflation. The annual inflation of Britain's shop prices accelerated to 2.8% in May, up from 2.7% in April, marking the highest rate of inflation since July 2011. Meanwhile, South Korea's consumer prices rose 5.4% in May from a year earlier, fueling worries about surging inflation, statistical office data showed on Friday. Albeit US employers added 390,000 jobs in May, the economy is still under pressure from high inflation and rising interest rates. With us to discuss on the high risk of a recession, probability scenario analysis and trigger point is JUI IQI Chief Economist Shan Said. Shan, thank you for being with us. Shan, recession is ringing the bells in many advanced economies like USA, Europe, UK and Japan. You have mentioned in your April newsletter about imminent recession. Goldman Sachs ex-CEO did, Jeremy Grantham, Bank of America did, and finally now JP Morgan CEO Jamie Dimon in his last week interview did. All major banks and global players and many others have been saying Fed is panicking since it's lost control of the market. What's the probability of a recession happening in 22 or 23 or even 24? Shan?
I think at the moment recession looks inevitable. And if you analyze history, and by trying to control or trying to tame price inflation, it has always caused economy to shrink. So what Fed is trying to do, it is doing at the wrong side of the table, and they have been behind the curve. And since 1955, if you see, rates have risen as fast as they will this year during 7 economic cycles. And out of 7, 6 of them followed recession within a year. In fact, although a recession is likely, but it will be different this time around, because I feel that recession will be much deeper. However, some analysts are celebrating that strong employment numbers, hourly wage rates are going up year on year. But the real inflation is around 10%, while the real wages have actually went down by 3.1%. You won't hear that in the mainstream media. Plus, if you see right now, food and energy prices are up. Crude price oil is up for 6 months in a row. And this has been the longest streak since 1983. Real wages have been shrinking. And on top, the share of disposable income in energy bills have increased. Wall Street Journal is saying that American consumers still have 6 to 9 months of consumer spending. But in my opinion, U.S. consumers just are left with 3 to 6 months. It is based on the premise that food prices are up on the average 45%. Energy is up 54%. Most of your income goes in buying food and energy. And moreover, economy is going into deleveraging. What is deleveraging? When consumers are paying off their debt. And whenever consumers, they are paying off their debts and economy goes into deleveraging, you are heading for subpar growth because you're not contributing anything to the economy. 70% of U.S. consumer consumption contributes to the GDP growth. But right now, the GDP growth is not as fast as it was expected because of deleveraging, because of higher food and energy prices. That will keep a lot of pressure on U.S. consumers, not on U.S. consumers, but also on European consumers, on UK consumers, and even Japanese consumers. So I think recession looks inevitable. The probability that we have analyzed and we have looked at the scenario in 2022, by Q4 2022, we expect advanced economies. The probability that we have assigned is between 60 and 70%. In 2023, we have given the probability of 80 to 90%. By Q1 2023, recession will hit many advanced economies. And of course, by Q1 2024, we are expecting 90 to 100%. The recession will eventually go deep into the system.
Shan, with the QE era finishing after 12 years and also central banks are set to reduce liquidity by $3 trillion in the next 18 months. This would send negative signal to the markets with higher liquidity risk. Moreover, market cap is down by 27 trillion in equity and bond markets. What can we expect from the markets? Have they priced in?
I think the only thing the market can expect is like shenanigans. I mean, equity and bond markets would take further correction. We at July IQ expect the market will take further correction by 10 to 20%. As the year started, the market cap of equity and bond market was at $190 trillion. But as of now, when I speak, the market cap of equity and bond market is trading at 160, 163. So as you rightly pointed out, it is down by 27 to $30 trillion. This reflects that markets are on the wrong side of the table, and they have not really priced in the Fed action. And Fed doesn't care about inflation. Fed will continue to hike interest rate by 2.5% by December 22. And it will create more turmoil. It will create more bazooka in the equity and bond markets. I think markets H2 from July to December onwards should expect there will be more correction, and it will create a lot of pressure on Fed, and that will create nervousness among those sophisticated and smart investors who have taken long-term position in the equity markets.
Mm-hmm. Sean, we have seen stronger dollar has put emerging market currencies under a lot of pressure with massive depreciation, thus inviting inflation in the economies. With inflation out of control, President Biden will meet the Federal Reserve Chairman Jerome Powell to discuss strategies to stabilize the economy and steady growth. Is it fair to say that Fed's policy of stronger dollar responsible for inflation in many economies and jeopardizing the recovery of global economy?
Absolutely. Fed action has created a lot of turmoil in many economies. But I must say this, that inflation will remain high in many advanced economies for the next 2 to 3 years. If even Fed decides to raise discount rate by 3% by April 2023, that's what the market is expecting. I believe that, inflation will remain high because of higher commodity prices, there are higher demand, there are supply constraints. On top of that, there are geopolitical risks. So once all these factors price in, I think inflation will stay high. As far as US dollar staying stronger, it's a tactical maneuvering which most of the central banks, they do by keeping their currency strong. What it does is, it keeps your imports on the lower side so that your imports become cheaper, so that the benefit is passed on the consumer. But right now, inflation is not a normal inflation, it's runaway inflation. And Fed has lost control of the market. So what the stronger dollar does for the global economy, stronger dollar put pressure on emerging economies, and because of that pressure, the emerging market currencies, they go down. Once the currencies go down, it brings in inflation. Once it brings in inflation, the central banks of those emerging markets, they are pushed to raise interest rates. And once they are pushed to raise interest rates, obviously the economy gets stalled, it gets stagnant. So I think, in my opinion, Fed should take a pause and they should understand what has gone wrong with the policy. The economic model for Fed is not working. It has created a lot of turmoil in the U.S. market. Market is not getting the word C. The confidence is not there. And Fed would create inflation for other economies for the next 2 to 3 years, which is bad. And stronger dollar is not helpful, not only for the U.S. economy, because it hurts the trade and commerce, and it hurts the overall momentum for the global economy. So I think overall, Fed's action has created a lot of problems for many economies, and inflation is here to stay for the next 2 to 3 years.
Mm-hmm. Sean, you have been sharing with Astro AWANI since last year that global economy is heading for a 1970 era of stagflation, or so-called higher inflation, low growth. Can we expect global economy to come out of stagflation or inflationary recession by 2022 or 2023?
Harits, I doubt, because right now many economies are going through stagflation. If you look at 40% of the global economy is in stagflation. Look at Latin America. There are 33 countries. 50% of them are in stagflation. Look at Europe. There are 44 countries, 75% are in stagflation. Look at Africa. There are 54 countries. Already 50% of them are in stagflation. So if you calculate, there are around 77 to 80 economies out of 194 countries which are already in recession. So 40% of the global economy is already in stagflation. And this stagflation is not going because it's a long haul. So I think it will create more troubles for those governments which are under stagflation. Look at global debt, which is trading at $305 trillion, which is 3 times the size of global GDP. So 1970 era is back, where commodity prices will stay higher. Commodity-based currencies will rule for the next 3 to 5 years because we are in a super cycle of commodities. Oil shock of 1973 and 1974, we will witness again in 2022 and 2023. So I think stagflation is here to stay, and the only thing that can bring global economic recovery back is the confidence, is the consumer spending, which is very dismal in many parts of the world. So I think overall stagflation is here to stay. It will be very, very challenging for many economies. Economic confidence, macroeconomic stability, and consumer sentiments will drive many economies as we move forward in the next 2 to 3 years.
Sean, my last question, we have about 2 minutes for our discussion here. Maybe you would like to comment on the investors. How do you see investors will take their stand? For example, looking for the central bank policymakers, and also facilitate how countries, economies facilitate investors in this kind of situation?
As I said, we are into stagflationary environment. So what happens in 1970, most of those sophisticated and smart investors who understand history and economics, they took position in 2 asset classes. One, gold and silver, and the other is real estate. And if you look at gold and silver, gold, it went up by 2,323%. From $35 per ounce in 1971, it went up to $850, $850 per ounce on 20th January 1980. So if you just do quick math, you will get to know the percentage rise of gold. And again, real estate, it went up by 150 to 300% in many parts of the world. So those investors who understand history and stagflation, they will go into tangible assets, the real assets. Equity and bonds market will remain under a lot of pressure because we are heading towards higher interest rate regime. Most of the central banks, they will raise interest rates to contain and to tame price inflation will continue to show its head. So because of higher discount rate, most of those investors, they take position in commodities. And commodity super cycle will stay for the next 3 to 5 years. And those economies that are based on commodities like, Canada, Australia, New Zealand, or Malaysia, and many other economies that have got commodities, they will have a stronger fiscal side, and the balance sheet will continue to stay stronger. Inflation is here to stay. Inflation is not going. We are in stagflation environment. Central bank globally will raise interest rates, and we are here for tough times.
All right. Thank you, Sean Said, Joy IQI Chief Economist, comment on the global inflation.
Binance Labs, the venture capital and incubation arm of Binance, closes a new $500 million investment fund with support from leading global institutional investor. The new fund will invest in projects that can expand cryptocurrency use cases and drive the adoption of Web3 and blockchain technologies. The new fund will invest in 3 different stages: incubation, early stage venture, and late stage growth. The fund is supported by leading global institutional investors such as DST Global Partners and Bri Capital. Other major private equity funds, family offices and corporations also subscribe to the fund as limited partners. The new fund will invest in projects that can extend the use cases of cryptocurrencies and drive the adoptions of Web3 and blockchain technologies. Changpeng Zhao, famously known as CZ, founder and CEO of Binance, said in a Web3 environment, the connection between values, people and economies is essential. If these 3 elements come together to build an ecosystem, it will accelerate the mass adoption of the blockchain technology and crypto. The goal of the newly closed investment fund is to discover and support projects and founders with the potential to build and lead Web3 across DeFi, NFTs, gaming, metaverse, social and more. The announcement of $500 million investment fund is expected to be allocated to projects spanning in all 3 stages. A spokesman of the National Health Commission, NHC, at the press briefing said China will coordinate the epidemic prevention and control work with social and economic development in an efficient manner. With local transmitted COVID-19 cases declining steadily, Li Zhenglong, Deputy Director of the NHC Disease Control Bureau, stressed the importance to consolidate the epidemic prevention and control results and further put the situation under control. Since May 30th, the number of local transmitted COVID-19 cases across the country has dropped below 100 for 6 consecutive days. But in recent days, Inner Mongolia and other local areas have appeared new clusters. At present, the situation of epidemic prevention and control is still grim and complex across the country. Li urged Shanghai to resolutely prevent the epidemic from recurring, while Beijing has to further block the extension of the transmission chain, stressing other places should carry out regular epidemic prevention and control measures and continue to consolidate the achievement of epidemic prevention and control. Local governments should coordinate epidemic prevention and control with economic and social development in a more efficient manner, make prevention and control measures more scientific, precise and targeted, and resolutely prevent the phenomenon like adopting simplified policies.
Move on to Indonesia. Indonesia has issued around 300,000 tons of palm oil export permits since the country restarted export, Senior Minister Luhut Panjaitan said on Sunday, while reassuring farmers and exporters that authorities would speed up the permit process. Indonesia, the world's biggest palm oil producer, on April 28 halted exports of the oil, which is used for cooking, in effort to control soaring prices at home. The government allowed exports to resume from May 23rd, but put in place policies to safeguard domestic supply, including the so-called Domestic Market Obligation (DMO), under which producers must first sell a portion of their products at home. The policy changes has resulted in red tape and slow issuance of export permits, industry groups and traders said, which help keep global palm oil prices high amid weak output from rival Malaysia. In Indonesia, Palm Oil Association officials said on Friday a number of palm oil mills have stopped buying palm fruits from farmers due to a lack of exports, while farmers complain that the price of fruit was yet to recover to levels seen before the ban, after falling by about 75%. Indonesia typically exports around 2.5 million tons of palm oil products per month. Luhut said the government will require palm oil companies to sell an equivalent of 300,000 tons of cooking oil per month under the DMO during a transition period following the resumption of exports. Indonesia's Economic Ministry official Musdalifah Mahmud at the same briefing said the government had made an adjustment regarding the export levy and a regulation spelling out the changes would be issued soon. She declined to give further details. Indonesia currently imposed a maximum $377 per ton levy for crude palm oil exports on top of a maximum $200 per ton export tax. The levy ceiling was raised in March in efforts to encourage more onshore sales. Japan's government is considering resuming a national travel discount campaign as soon as late this month to help the tourism industry recover from COVID-19 slump, the Nikkei newspaper said on Saturday. The Business Daily reported a revived go-to travel campaign would likely serve as a core measure to stimulate consumer demand. Japan is set to ease border controls to let foreign tourists in from July 10th as coronavirus infections ease. The government will decide on the campaign soon, the Nikkei said, without specifying time. Officials at the Japan Tourism Agency could not immediately be reached for comment outside business hours. The campaign rolled out in July 2020 just as COVID was gaining strength, subsidized half of the travel expense up to 20,000 yen or about $150 a night for each traveler. The program helped boost tourism but was shelved 5 months later as the pandemic surged.
And next, we have the Ukrainian Deputy Minister for Economy, Trade and Agriculture said that his country was not only in need of reparation to rebuild its economy, but also a new plan that would make Ukraine leap into the future. Taras Kacha said that a new type of Marshall Plan would help the country come closer to European Union and G7 countries. The Marshall Plan was a program outlined in June 1947 by the United States Secretary of State George C. Marshall to help rebuild the economies of Europe and Germany following World War II. Kachkar also insisted that Russia should pay reparation for the damage it caused to the Ukraine in the war. Marcus Bent, Deputy Managing Director of the European Investment Bank, said that it was important that Ukraine accesses market again as soon as possible and be able to export its product and rebuild its economy. Ukraine is one of the world's largest exporter of wheat, corn and sunflower oil. According to the Kyiv School of Economics, due to the war, Ukraine suffered around $4.5 billion worth of damage per week in civilian infrastructure, and the country's total economic losses could soon rise up to $600 billion.
Kita berhenti rehat seketika, bersambung selepas ini.